Good day, fellow investors. There was a great comment here on how miners have not benefited from higher prices in gold and silver yet. Let's check gold miners now. We have discussed gold already, and gold did greatly over the last few years, and especially the last year, because more and more central banks like Turkey, India, Poland, China have been buying more and more gold, perhaps going away from the dollar. But gold prices up significantly. However, gold miners, we can say, have been flattish for the last 5 years. We'll go through each of the top gold miners in the VanEck Gold Miners ETF, and that is what we do on this channel. We recently did lithium, and I think that the majority of the 250,000 subscribers, almost quarter, so subscribe for the gold there, have been from mining. We started with gold, with copper, with lithium. So we could say that I've been doing those analyses for more than a decade now, and I hope you will enjoy the process there. So let's look at the situation. Let's analyze miners from a price to free cash flow ratio at gold at 2,500. What are the valuations there, and how does the higher price of gold benefit them, and whether they are now underpriced or overpriced in relation to that? Because if we start immediately with Newmont, we can see that gold prices have more than doubled. Newmont stock is down 10% over the past 5 years. So something must be very wrong in the gold mining industry, or especially with Newmont. We can see here there is a dividend, and we will compare the cash flows to the market capitalization of $43.6 billion. I've looked a little bit at Newmont, and immediately this is the key factor with miners and has been the key factor for the last decade or so, and you will see a pattern through the whole video discussing their acquisition mania, and then when things go wrong, the divestment mania. So Newmont is now in the divestment process. They are divesting CC&V, they are divesting Eleanor. So all these things, divesting, selling, all those selling. So they are selling Eleanor for $795 million in cash, and they merged with Goldcorp in the acquisition merging mania 5-6 years ago, and you can see Goldcorp paid $420 million for just the project in 2006, plus the investments, plus this, plus that, and they try to usually get rid of the things that don't look good on the balance sheet or in the portfolio and just stick to the good things. But usually it is the shareholders that pay for that buying and selling because of no returns. Nevertheless, let's look at the current situation and let's see how Newmont is priced in relation to other things. They say that it is a transformational year, and yes, Newmont has to be transformed, but as a shareholder, when you see integration, rationalization and transition, you know the company has been in trouble, and we have to see now how will that rationalization and increased profitability, increased cash flows result. And they say more divestitures to come, more selling of the bed to make things look better. Now, they are on track to deliver a solid finish to the year, but if I do some calculations here, 1.8 million ounces produced, gold prices 2,600, minus gold all-in sustaining costs, let's be a little bit more on the expensive side, 1,500, that's $1,000 per ounce of gold produced. Thus, for 1 quarter, Newmont should be doing $2 billion in free cash flows. This is from slide number 6 that I get there. Okay, we can then deduct the sustaining capital, thus 1.5 billion in free cash flow per quarter times 4 quarters. Newmont should be now doing 6 billion in free cash flows and that should then be valued from a company perspective. The plan is to consistent production, sustaining capital spend of 2 billion. They are also investing in developing capital and all these projects that they have acquired here and there. I remember the Bruce Jack, when it was still a company trying to be acquired by someone and they found the buyer, and they here is a nuggety ore body. And I remember it was incredibly difficult to analyze, because when you have nuggets, if you miss just a little bit, you get nothing from a gold production perspective. And they are still trying to solve that nuggety ore body, but they had to buy it because they need to be the largest miner, bigger than someone else. So that's always the story with miners there. Okay, they have good jurisdictions, great assets, they're tier 1 assets, long mine year, nothing wrong with that. And then we look at the financial performance, we look at the mined ounces, the revenue is there in line with higher and higher gold prices. But then I look at the cash from operations. Okay, that's already lower than the 2 billion, but capital expenditures, now those are here, so those are not all in sustaining costs, because they try to trick us a little bit on what is sustaining, what isn't. The capex there is high, and what is left is the free cash flow of 760 million. So that is far from the 1.5 billion that I calculated. That's actually half, and we are down to 3 billion in free cash flows per year on the current situation. And you can see here that with gold prices just a little bit lower, the cash flow was good in the last quarter with higher gold prices, but immediately with lower prices on beginning of the year, it was much lower, and actually just 500 million for the whole first half of the year compared to the last quarter. And then I look at things, okay, what is impacting cash flows, what is benefiting to cash flows? We have net income, but depreciation, and that is deducted, but they need to have more and more operating assets, liabilities, constantly things that are not included in the all-in sustaining cost, but are there as a cash outflow, and that simply lowers cash flows. And then there are also additions to property, plant, mine, and development that they need to simply invest just to keep up production. So when you sum things up, even with higher gold prices, we should be getting to 3, maybe 4 billion of free cash flow. That's a little bit stretched. And we have immediately a P/E ratio, or price to free cash flow ratio, which is what you look with miners, of 10 to 15. So they now have approved 3 billion of buybacks, and if they actually start putting their cash into buybacks, then I think the stock could rebound on just buybacks, all else equal. So Newmont, if I put it on the table here, okay, price to free cash flow of 10 to 15, not bad. Buybacks could push the stock up. So let's say a small positive here for Newmont, but the big risk is gold prices went up to 2,600, those can go down to 2,000, and that is then the risk. And that's why also this might not be that exuberantly priced when you look at it. There is always risk. Agnico Eagle Mines, similar market capitalization to Newmont, dividend yield 2.6%. Let's look at the business. And again, as with all miners, they are now acquiring O3 mining. Every miner is or divesting or acquiring, always doing something, and the investment bankers helping there are enjoying the bonuses at the end of the year at the cost of the shareholders. But the guidance there, gold production, let's say 3.5 million ounces, cash costs less than 1,000, thus they should be very profitable. And you can see here something very interesting. Agnico Eagle has actually beaten the S&P 500 over the last 2 decades. So they have been doing well over time, of course also benefited from the huge run up in gold prices, but also increased production. All-in sustaining costs are relatively low when you calculate that compared to Newmont, for example, with 1,500, but they still have a lot of capital expenditure for the year. Their margins, due to the low costs, are higher than the peer average, which leads into higher cash flows. And if their cash flows continue on that side, we are also looking at improved gold prices. And for now, they haven't used much money for share buybacks, dividend, then again, lowering the debt also from future acquisitions. So that's something that's an ongoing process with miners. But if we look at free cash flows, I would say 557 million per quarter on a good quarter, so nothing wrong there. And that should lead to 2 billion, maybe 3 billion per year if gold prices persist higher. And that's again a price to free cash flow ratio of 20 to 15. If I compare that to Newmont, Agnico is a little bit more expensive, the stock also doing better. However, we have compensation of dividend, some buybacks, but we'll see also how that develops. However, a little bit more priced, it is likely better than Newmont, less capital deployment mistakes, and therefore a little bit more expensive. But still, that's a 5%, 5, 6, 7% yield from a miner. That's not spectacular. Now, number 3 is Barrick, used to be number 1, but you can see that their performance also over the last 5 years, like when they go on acquisitions, acquiring Gold and things like that. Yes, world-class resources, but they haven't done really well over the last years. Operating cash flows really going well on higher prices. That has been practically eliminated, which is always a positive. They are returning capital by doing dividends and buybacks, but still there is always a lot of sustaining capex for little growth projected going forward. And here you have always this growth sustaining 2 billion, growth 1 billion, but we can argue that is always also sustaining. And what is left is not that much when it comes to free cash flows, even at higher prices. And they always project, oh, another year and then costs will go down, profitability will go up. But that has always been the chart there. And also, when they merged with Gold 2018, I just went back to look, and you can see here how they are promising gold. Their scenario was for gold prices to be higher or lower. We are now 2x from that, and the stock didn't do much since then. Also, 2020 production. Keep in mind, they always say that's growth capital, but production was 5,000 ounces and was projected to remain at 5,000 ounces. Cash costs were projected to go lower, but actually they were also projecting more production going forward. That would now result in 50% growth. That actually didn't happen. And if I look at the cash flows now, again, maybe 1.5 billion, huge costs to run the mines, huge sustaining costs that are then not included in the reported costs as always. And then you have a 27 billion market capitalization with 1.5, maybe they'll push it to 2, but that still leads to price to free cash flow of 20, dividends, some buybacks, but nothing spectacular on a pricing perspective, what you would expect from a miner. Now, something very interesting, a business model that worked extremely well in the last few decades, and that is gold royalty streamers. As you can see, the stock also reflects there, but also it is always and has been always a little bit more pricey. The last few years, the price has been reflected also for the quality, but I'm always wary of this miners, great business model, but always the stock is pricey. And yes, the advantage is that in their business model, they're giving money to miners and they are getting back a contracted offtake at a very, very low price. That's how they get their return on their investment. And then the more the miner produces, they get more and more over time. They make a contract for eternity on that production on the mine, and that is a great business model. It helps the miners, the developing miners that don't have to take a loan, but they have to give up some future sales and production. And this is what they are doing. Here is an example. They announced an acquisition of a gold stream from Alamos Gold Kurmuk project in somewhere Eritrea, if I'm not wrong. And how does that work? Well, here are the terms. They will be purchasing 6.7% of the payable gold up to a total of 220,000 ounces, and then it will drop to 4.8% of the payable gold, and all of that for a price equal to 50% of the spot of gold. So if gold is 3,000, they pay 450, and the rest they can sell, and that is how they make money. They don't have risks related to operations, to this, to that. All they need is that the mine becomes producing, that is working and producing more and more. And as the mines produce more and more, thanks also to higher gold prices, they make more money. So great business model, very low risk. The only risk is if the mine stops producing or something like that. But you can see here how their margins are huge. Their costs of acquisitions per gold ounce are very low. That's how they contract that. And also for silver, and nothing wrong with the business model. Very healthy business model. Great growth over the last 2 decades. You can see here at current commodity prices, estimated 1.5 billion in annual cash flows at current commodity prices. They have been increasing the dividend, growing steadily. Now, nothing wrong. They are also paying a little bit more dividend than other peers. They are focused on precious metals, so if you're looking for that exposures, nothing wrong with Wheaton. Great business model, invested in streams, 10 billion, but that is over the last 20 years. Cash flow generated to date, 11 billion. So it's not a huge extreme return, but it's that benefit that those contracts, offtake contracts, last for a very, very long time. And generating over 1.4 billion in annual cash flows at spot commodity price by 2028. 1.4 billion, when I compare to the market capitalization, okay, not that crazy, but still on the expensive side, especially on the low dividend yield. And if commodity prices go lower, that's always a risk. It will also go lower because it's related to that selling. However, very low risk, and you have the 1% dividend, 4-5% growth. That is a 5% return expected from Wheaton. Not great, not stellar, but not even bad. However, there is always risk in the gold price. Franco Nevada, not such great performance as Wheaton, a little bit weaker, but same business model. They are constantly growing. They lost, I think, here a big hit with Cobre Panama, where they had, I think, a stream. So that hits them. That is the risk. If the mine stops working, then they have to cut on that. They don't get much more. But with the years and everything, they always try to grow. Very well diversified. And okay, dividends paid since IPO, 2.4 billion. But when you compare that to the market capitalization, 262 million, okay, IPO shareholders are getting a good yield, but the IPO was back when? In 2008. So that is not so great. And also, this is something very interesting. So Candelaria, London's mine, you can see they invested, and over the last 10 years, they got just a little bit more out than they invested. If you need 10 years to get your money back, that's 7%, let's say, yield on investment. Okay, now they are still getting that benefits, and they calculate the net present value based on the mining projections for that mine going forward. However, it's not such a great return in my eyes. It's a great business model, very low risk return, but okay, they are still investing. Cobre Panama optionality going forward. I haven't dug what's going on there, but if they return to that stream, then production, that should be good. However, that's what, 20 billion US dollars, 260 million dividend, that's 1% plus again growth. So you get to that 5% yield. That's not stellar, not that great, let's say. If we go to the next one, Gold Fields, NYSA GFI, investing, growing, a little bit higher production costs there, and you can see also how higher production costs when gold prices go up, there then is a great benefit, and that is also what happened to the stock there. But look at the free cash flows. Despite everything, negative free cash flows for the first half of the year. That means, okay, they are still investing into growth. It is also South Africa, deep mining, that's usually more expensive mining, riskier mining. So I don't know if they specialize in that, but also that should lead to a higher yield expected from investors, because you never know. And you can see here the very high all-in sustaining costs. So if gold prices go down, they suddenly don't make any money. I think they are announcing some improvements in that all sustaining costs, but that is always a risk with such mining companies. Another discussion on gold miners, they have acquired Osisko Mining, and you as a shareholder could have bought Osisko here for yourself, but now if you're a shareholder of Gold Fields, they decide, okay, we are going to pay 50% more and we are going to manage it. There are no synergies when it comes to mining, and this is how gold miners simply like to destroy shareholder value, because they like to pay for something that you could have bought on your own for much lower price. And yes, it is an attractive total acquisition cost based on very exuberant analysts that say that this is worth 3 billion and they bought it for 2 billion. Why don't the analysts buy it for 3 billion if that's worth 3 billion? So always the same stories with minings. The outlook is there, a little bit lower costs, production costs hopefully, but with other costs, with another 1.2 billion in capital expenditures, the cash flows are not that stellar. Even if we adjust for the spending on growth here, then we get to around 200 million in cash flows times 4, 800 million. So we are at a higher 5-6%, let's say, free cash flow yield. That's reflected also in a higher dividend yield, but again, not that stellar. Maybe with the growth and everything, especially with higher production costs, if gold prices go down just a little bit, then they don't make any money. So they will be more volatile, and that is also seen in the stock price. Anglogold, 1.86 dividend yield, and you can also see how this was a nice chart that I found from 1984. The stock price at IPO was 40, and we are now 50% down, and we were also 75% down with ups and downs. So that's a story of a gold miner over 40 years now, my dear friends. And they have these assets, tier 1 assets, tier 2 assets, always something. And what do? They go to make an acquisition of a mine in Egypt, where 50% is owned by the government. But okay, pay 2.5 billion. Again, the stock of Centamin goes up. Everybody happy as a Centamin shareholder, not those that paid a little bit too much. But okay, if we look at free cash flows, 347 million for the third quarter, that is okay. That's 1.2 billion over likely the year if gold prices stay higher. Free cash flow, okay. But when you add all the things, I get to a price to free cash flow of 10, but the results of that price to free cash flow seem to get lost. through acquisitions, and then you are left with a 2.5-3% dividend yield that simply goes nowhere. And within the article on the acquisition of Centamin, this was included. The acquisition coincides with a flurry of deal activity in the gold mining sector over the past couple of years. So Newmont buying Newcrest, Anglogold, Goldfields acquiring Osisko Mining after they didn't manage to acquire Yamana Gold because Agnico Eagle beat them. So that's always what miners do. You can buy yourself the share for half of the price, but the managers want a bigger plane. They want to swing a bigger gold nugget or whatever because they get paid more with these activities. Investment bankers get their fees, and everyone happy at the cost of shareholders. So this is the issue with gold miners. It should be just mine by mine without, there are no synergies from a mine to Africa to, I don't know, Brazil or northern Canada. So we should have each mine stocks and you can buy whatever you wish. But okay, that's the environment there. And let's go to the next one. Kinross, again, dividend 1.2, did great over the last 5 years, up 100%. But look at this, very cheap. So this is up even more from the lows in 2022, and gold prices weren't even that low. So when you look at things, analysts are very positive. Everyone is saying it is a buy. Now the free cash flow is 8.5%. They have very nice chart here, so they have a higher cash flow yield compared to other free cash flow yields, and you can see this is the name of the game, 3, 4, 5%, nothing stellar. Likely they have developed well over time to reach good cash flows on their production, but you see also here the potential. Newmont has great production but very low cash flows compared to their potential. So if Newmont can really turn around ship, that could be something, but that is again then the question. Year-to-date free cash flow 522 million. On a valuation, if we look, they say they are cheap related to others, but these are expensive things for miners in my perception. All-in sustaining costs are relatively low, capital expenditures is always there and will always be, and they have a good reserve base, 22 million ounces of 2 million ounces of production per year, so they can produce another 10 years, then the resources will likely be turned into reserves over time. That's the story of a miner. But then again, nothing spectacular. Price to free cash flow is there, but lower costs of production also lead to less upside because the margin improvement isn't that great. Okay, nothing wrong with it, but then again, nothing too spectacular, but on the cheaper side when we compare to gold miners. Let me know in the comments if there are some specific risks that I missed. Zijin mining, very interesting. During gold at low prices, copper at low prices, what did Zijin do? They were just acquiring those metals all around the world for the sake of the benefit of Great China. They were buying assets for the metal, not for having a bigger business. And as metal prices went up, they are making suddenly more money on those things that they were buying. So really good, we can say again, fairly priced for what they are doing. They're even paying a dividend of 2%. Fairly priced in a market, let's say, environment. I would look at these things with a dividend yield of 8-10% across the cycle in a negative, let's say, gold price environment. Another one, Northern Star Resources, dividend yield 2.6%, investing into growth. They should be reaching higher growth with Kalgoorlie mine. They would like to deliver cash to shareholder returns, and that's returns now. They are delivering 500 million by paying 20-30% of earnings. Okay, and that's always, where are the other 80% going? In growth, but there is always a big question mark on how will that growth pan out over time. Okay, they are trying to lower their operating costs, and here you have a cost curve. And this is always nice to see when it comes to whatever commodity. If you're here, if gold prices go up, you suddenly start making a lot of money compared to the zero you are doing now. But if you're here, now if gold prices even go much higher, it doesn't change how much profitable you are. And on the guidance, a lot of investments again going into something that you cannot know with mining what will be the issues in the future. Nevertheless, again, priced for already performing good, already for the growth there. So 10% cash flows, investing in growth, that should lead to future production. So nothing wrong with it. Again, as we move from this expensive part, we are now getting again to, let's say, cheaper environment of gold miners. Royal Gold did great over the last few decades. Again, the benefit of streaming, they are not incurring many of the costs and risk associated with mining operations. Here they are, good cash flows, okay, standard compared to the market capitalization, perhaps on the cheap side of the streamers, but then again they are always costs, so 416 million of free cash flows, and that's again a 5% likely return, dividend plus the growth, in line with the other two streamers. We are still left with Alamos Gold that did greatly, but you can see here when gold prices go up, it does great. When gold prices go down, it becomes very ugly, and that is always the risk you have to keep in mind with gold miners. Depending on the production costs, it can get very, very ugly. So they say they are cheaper, but you have seen the risk on the previous slide that explains also why they are cheaper. They will try to decline costs, 16 years of production ahead. So a lot of cash flows from the miners need to constantly find new ore to mine, and always the future ore is more difficult to mine. All-in sustaining costs are relatively good for the company, and you can see here now everything of that is already reflected in the gold price, and let's say priced in line with the second bunch of miners there. My conclusion on gold miners is that first, I have to say I don't own any gold or gold miners at the moment because I simply don't like the risk and reward, the attractiveness of it. The yield to shareholder is not great. 5%, 2% dividend yield plus some growth, so you get to 5-6%, and the bad capital allocation with the acquisition mania is continuing. That will also have an impact, especially if gold prices go down in the future. Now everyone has cash flows from higher gold prices and then go on a spending mania. Now, I could think of gold and gold miners as in a portfolio, someone needs to have exposure, so you can have an all-weather exposure to, let's say, gold or gold mining. At the moment, for myself, I don't see it as worth in the long term, but let me explain that strategy. If you look at gold prices or gold mining ETF, you can say, okay, if I start with a 5% allocation in my portfolio, and then if it goes up, let's say 50%, then it gets to a 7.5% allocation in my portfolio. Then I sell the 2.5%. That's a 2.5% yield on your portfolio, and you bring it back to 5. If it then goes from 5% down to 3% of your portfolio, you bring it back to 5, thus you buy in the lows, and then you sell the part you have increased, bring it back to 5 when you're again to, let's say, 7% yield with the portfolio. And that can be done with gold. You can do it with gold miners, perhaps more volatile with miners, thus you can have higher of that yield, maybe even get a dividend. But also miners might be cheaper if gold prices remain at this peak. Perhaps the market wants to see gold prices stabilize at these levels to revalue the miners. If I would put the VanEck Gold ETF on our risk and reward quadrant, in the current environment, from a value investing perspective, not from a all-weather gold in portfolio perspective, I would put as very high risk for little or low reward. It could easily happen that gold goes below 2000 in the next year, and then you would also see gold mine stock prices go lower. So at the moment, people are getting excited about gold. There is an acquisition mania going on, which means it is risky. Of course, gold can go to 5,000 on inflation or anything, but then again, it is the question, how will gold miners deliver on those higher prices? So risky for now. We'll keep watching. If you want commodities, food is much cheaper now, some oil. You can also check my research platform for some hedges. Berkshire is cheap, mostly in cash, US treasuries, and from a value investing perspective, we do not cross this line, so we don't want to take excessive risks, and at the moment, gold miners give more risk to a portfolio their benefit.